Yesterday, I lost $2,218.47 on a trade that looked perfect. But here's the thing, that loss is the exact reason why I've made over $2 million trading. Because after 5 years, 10,000 trades, and blowing up 247 accounts, I've learned what actually matters in trading, and it's not what you think. In the next 70 minutes, I'm giving you everything. The strategies that survived all of my testing, the risk management that saved my account, the tools I use every day, and the psychology shifts that took me from losing everything to consistent profits. This isn't gonna be one of your buy here, sell here strategy videos. This is the real stuff that they don't teach, like why winning traders still lose money, how to actually execute trades properly, and how to start with a small account. By the end of this video, you'll have my complete trading blueprint. Miss any part of this and you'll make the same expensive mistakes that I did. Watch till the end and you'll compress 5 years of painful lessons into the next 70 minutes. Let me kick things off by destroying every trading lie you've ever been told. Starting with this. Profitable traders, they don't win more, they just lose better. Now, what do I mean by that? Let's just go over the brutal truth of my first couple of years of trading. I kind of like, but mostly dislike talking about it because it's just embarrassing, all right? If you ask any person starting anything, whether it's something like trading, a career, a hobby, the first couple of days, weeks, months, years, depending on what it is, are usually going to be a little bit rough. What I mean by that is I blew up account after account. Some of you already know, I started off with options trading. Now, starting trading as soon as you turn 18, loading your passport into, a stock brokerage and putting in $1,000, which for an 18-year-old is always going to be a lot of money, trying to save that up working minimum wage, and then just blowing it up within a few days just because, well, 0 DTE options on Tesla have the most volatility, so obviously that means you'll make the most amount of money kind of mindset. Let's just say that kind of mindset doesn't help, all right? It makes it a lot worse. So yes, I did start out with options. Yes, I did blow $1,000 account, which I just kept depositing into at least 5 or 6 times before I had a complete mental breakdown and I realized maybe trading is not for me. Maybe I should just stop here. All right. I've only lost half of my whole net worth at that point. Not too bad. Could be worse. And I was just thinking, if I quit now, I could probably just get away with keeping the rest into this little stock brokerage thing. It's kind of like Robinhood, but for Canada. Just invest in my tax-free account, and eventually I'll recover in like 5 years everything I lost. I can just figure something else out. All right? Fuck the trading stuff. Maybe it's not for me. And I remember I had a couple mental breakdowns during that time in late 2020 when I was thinking about all this. And I ended up going to go see one of my friends over Christmas time. And I told them, yo, I am losing my mind, dog. Like, I don't know if I can continue doing this. And he told me, well, what are you going to do? Are you going to stop here and just let that loss cripple you and that's it? That's the end of it? Or are you going to continue? Are you going to prove to yourself that trading is not gambling, that you can actually succeed at this, and that it's something which, if you put in the hours, if you actually apply effort and you have a good plan, you'll get results. And I mean, obviously, I blew up my accounts over and over, not because my risk management was perfect, but because I had no risk management, right? I started off trading options because I heard somebody on YouTube tell me that that's what I should be doing. I started off trading options because I thought that's the most volatility. I started off trading Tesla options because, well, I don't know. It's fucking 2020, dude. Like, everyone was talking about Elon Musk. Elon Musk was pumping Doge, and Tesla was moving a lot, right? Kept doing all-time high after all-time high. So I thought, let me just get a bunch of call options and I'll do good. And I had a small account and I wanted to manage my risk. It makes no fucking sense. So I would buy 0 DTE options. In other words, options that expire the same day. And I wasn't always waking up for the market open. Usually I was waking up a little bit later. So silly. Case in point, I kept losing all my money over and over again because I just didn't have a clear plan. I didn't know what the fuck I was doing with my risk management. And yeah, I mean, I lost thousands and thousands at first within just like a month or two. And the emotions, like I said, they were there and it just did not make anything easier. Now, in terms of strategies, okay, let's just get into the charts and let's talk about the kind of strategy I was using. And to do that, what better way than looking at the stock itself, Tesla. So let's do that. All right. So we're in regular trading hours, which is when you're actually able to trade stocks. And here, well, trade stock options. So here's what I was doing. I was looking at the markets. I was on the 1 minute, 5 minute, I don't even really remember anymore. And you guys are going to understand the point in a moment. And I was just looking for direction, whatever the fuck that meant. And as soon as I would see some direction, I would then play it. So here's an example trade of what I used to do. I used to basically look at the charts. Maybe I would hop on right here and I would start to look at what price action did and what it was going to do next. So I saw we moved down very heavily overnight. I still had no idea what that really meant. And I saw we were going down. So I said, fuck it, I'll get some put options. Easy peasy, my boy. Doesn't get easier than this, dog. Doesn't get easier than this. So maybe like right here, I would choose to get some put options. In other words, I would bet the markets were going to go down. And that's literally it. I would just go onto my brokerage. I would just, buy some put options, bet the markets were going to go down, buy usually one contract because I couldn't afford more than that without, losing my mind. And then usually it would go in my favor. As you can see over here, it did actually go down a little bit. But because you're trading 0DTE options, because of time decay, because of implied volatility, because of all these things, if the markets go in your favor but sideways and time passes by and you're just holding on to it, you'll actually lose money, which is why I don't recommend anybody really trade options unless you have a lot of capital and you've been doing it for like a fucking decade and there's nothing that's confusing to you about it. But whenever you start, right, no matter what kind of trading you're going to do, it's going to be confusing at first, but stock options is going to be a lot more confusing than anything else, so I do not recommend it. All that to say, let's say I would buy a $150 contract. So with a $1,000 account, I'd be risking $150. In other words, 15%. I would get in here. I'd be up $50, maybe $100. Sometimes I only have one memory of me ever closing a profitable trade that way. I remember I was actually on a phone call with my mom, and I had just closed a $150 profit stock option play on Tesla, catching a little move up, something like that. Closed it out pretty fast. And I got pretty lucky. I was like, hey, I did it. My account was down 40% that week. So funny. But anyways, I felt good about it. But yeah, so with this kind of situation, I'd be up a little bit, and then usually that shit would have expired to be worthless. And by the time the market would close, I would just feel like shit. I was like, fuck, I just lost another $100, another $200. And every time I'd be relating it to like my expenses, which were super low back then. My apartment was like maybe 350 USD. My food was super cheap because I was just buying God knows what. Barely eating, to be fair. I was fasting. In other words, that's what you call being broken and having bad eating habits. And yeah, so every time I'd lose, I'd think, fuck, man, that was like 50 days worth of food. That was like a month's rent. And after losing thousands of thousands, it starts to get really heavy on you when you have that kind of mindset. And pro tip, if you do still have that kind of mindset, whether you're doing well or not, whether you're trading $50 or $10,000, I would recommend stopping that as soon as possible. Because in what world will that actually help you to be thinking about a trading profit or loss ever in actual real world money? It just makes no sense. It's never going to help you. It's never going to be positive. If you were to look at your end of month, like if you were to report, if you were to like journal and analyze your entire month and notice I followed all my rules, I did maybe 6R, and I got this much in profit, then yeah, you could relate it to, okay, amazing. That's like 3 months worth of expenses. Amazing, right? That's great. But not as you're trading, and especially not if it's impacting you negatively. So that is how I used to trade. That was my main wave analysis. Says a lot, doesn't it? Randomly getting in, randomly getting out, not really understanding what the fuck I was doing, barely even understanding what open, high, low, close or a candlestick was. And that's what I was just doing day after day after day. Great strategy, right? Now, let me just explain really quickly why this failed if it wasn't obvious. For one, I was using stock options, not understanding how to utilize a stop loss or a take profit accurately. This is one of the reasons why I don't recommend stock options, because not every single brokerage will let you use a stop loss and take profit. For two, even if you are trading stock options and you can have a stop loss and take profit, the price you see here, in other words, 304, 305, 306, is not going to be what you're using for your stop loss. It's going to be the actual price of the contract. You can use the chart, obviously, of the contract, but it's not going to be anything close to the actual, in this case, Tesla stock chart. So very confusing, very difficult to do. You would have to basically look at the chart here and manually get out. But even then you could lose another 20% than you expected just because of a bit of volatility. So I really don't recommend stock options, guys. Like I said, it's not that it doesn't work. It's not that it's a bad asset class or a bad way to trade. It's just inefficient, right? And there's so many better ways to actually trade based off, once again, my experience and everything that I've seen. So that's the main reason why it didn't work, all right? Because I had no fucking idea how to place stop loss or take profit. And even if I did, there was no technicals behind this. There was no clear analysis. There was no, oh, look, there's a liquidity right here. We just swapped the liquidity and we inverted a fair value gap right here. So I'm going to get in based off 100 trades back tested. There was none of that. So there was no way for me to ever succeed because I had no data. I had no fucking clue what I was doing. And I hadn't really back tested or demo traded, because how the fuck do you demo trade stock options, dude? Like, this is what I'm saying. If you start with stock options, you're just going to screw yourself badly. If you start with, indices, Forex on a CFD prop firm or CFD broker, it's going to be so much better. So much easier to calculate these things, to manage your risk, and to actually learn something proper. So guys, let's talk about psychological traps, because there were so many that I was falling into. One of them was the obvious one, revenge trading. So obviously in one day, I might usually only take one trade because that's about all I could do. My account didn't let me take more than one trade, and if I did, I would lose like half the account. So there were days where I would take a trade, I would close it out very, very fast, trying to get out break even. But because it's stock options, usually break even doesn't fucking exist. Plus the commissions were insane, by the way. So on $1,000 account, the commissions can add up to like 5% of your account for just one trade. Another reason not to trade stock options. So anyways, revenge trading would typically happen like this. I would go ahead and look at the markets. I would start trading. I would maybe place a trade. Try to get out break even because, I don't know, I wasn't confident. I wonder why. And I would lose maybe like $50, $100. And I was like, damn, bro, that's annoying. Like, let me just recover that. The classic. All right, that's what literally every single motherfucker says when they revenge trade. I swear to God. I swear to God. It's one of the classics. So I would enter again, lose maybe $50 just due to commissions from opening up the trade, have a lot more pressure. And at that point, guess what would happen? I would either win a little bit, get greedy, trade again, maybe even with more risk, trying to risk what I just made, but obviously I can't risk accurately. So I would lose a lot more, like half the account, which has happened many times. Or I would lose. I would just skip the winning part. I would just straight up lose. And then I would either continue until the account was blown, or I would stop and I would be sulking and in an absolutely insanely depressed state for the entire day and the entire night until I'd wake up the next day to start the fucking cycle again. So that was easily the worst psychological trap. Revenge trading is the worst. And yeah, I mean, whether it's overconfidence, revenge trading, or fear, it's always going to bite you in the ass. Because if it's fear and you stop trading for a week and then you get back at it the next week, but you still haven't psychologically recovered because obviously you didn't back test, you don't have any data, dude, you're going to feel terrible. It's going to be like PTSD, right? So it's basically what PTSD is. It's something traumatic in your past, which is getting activated again, right? Kind of like a traumatic deja vu. So whether it's been a week or a month, if it's the exact same thing happening and I'm losing again and I'm in a stressful state because I'm losing the only amount of money that I have saved up and I wasn't making any money, no matter what you do, you're going to be in a trauma state and you're going to lose. And if it's the opposite, where you're in greed and you're making money and you don't have a clear system or risk management, guess what's going to happen? Probably going to blow the fucking account. But Seb, if you're winning, then why would that happen? Because you win, maybe you double the account, and then you could very easily lose all of it because you risk more. Think, like I said earlier, you're going to risk your profits, which at this point would be 1K. But if you do something incorrectly, if you step away for too long, like super simple. If you forget it's a half day and then you accidentally keep the contracts open, the next fucking day, if that even is possible, you'd probably lose everything, right? Or get really lucky. Or if you have 0 DTEs, they're expired, worthless. Like I said, stock options are annoying as fuck. Super fucking annoying. So this led me to the biggest realization in my entire trading career. This was the moment which gave me like the entire fucking foundation I have now. The key realization that I had about why most traders fail, why most humans, right? Most traders are human, I would think. Why most of them fail. I mean, to be fair, there are people which have their chicken straight. It's not exactly a chicken, but hey, they perform even better than humans, so well, fuck myself. What I'm trying to say, guys, is my key realization was just that we fail because we don't set ourselves up for success. We fail because we are told to do one thing and we do something completely fucking different. All right, my best friend is a bodybuilder. He is 6'3", fucking jacked. Like Marcus Aurelius, maybe not Marcus Aurelius. I don't know what his physique was like, but like Greek god like physique, he probably surpasses that. All right. And he's told me many times, Seb, you should hit the gym, do a bit of this, do a bit of this. And it's not that I didn't listen to him. It's more just that I didn't really feel like I was ready to step into that fully. Now, if I don't listen to him, if I don't take similar steps, if I don't take his advice, will I get similar results to him? Do I have the right to complain if I don't achieve the same physique as him in a year if I don't do anything? Or if I try to do something completely different and he clearly tells me that's not going to work? Do I have any right to complain? No. But the problem is, people think trading is different. People think that for some reason, I'm part of the 5% of traders that will succeed. Meanwhile, bro, do you know what 95% is? That means out of 100 people. Get 100 people in like football field or in a room, big room, I guess, like in a big gymnasium, like a basketball court, right? Get 100 people and pick 5 people, make them step aside. Look at the 5 people, look at the 95 people. You'll understand what 95% means in that moment. And if you think you're part of that 5% for some reason, amazing. Prove it. That's it. Just prove it. It doesn't have to be more complicated than that. If you can't prove it, then why are you even fucking trying to make a point? Anyways, what I'm just trying to say here, guys, all right? I like to ramble a lot, as you can tell. The key realization I had is just that most people, they don't bother actually doing the things which give them the results. They don't actually take seriously the words of people, the predecessors, the people around them which are succeeding. If I were to tell you right now, if you take the next 10 hours that you invest into trading and you were to spend 3 of those hours making sure that you have unlocked the basics, you understand your platforms like TradingView, wherever you're trading, you understand very clearly what your edge is, right? You study whatever the edge that is, whatever strategy, you go into the charts, you look into the concepts, you understand them well, then you spend the next 2 to 3 hours back testing heavily, maybe even 4 hours. Out of the 10 hours, most of it's just going to be analysis and making sure you have good data. You take multiple of those hours just to back test and back test and back test and optimize and gather data. And then you take the next couple of hours over a week to do demo trading to make sure that your back test actually applies in the live markets, that it actually gives you similar results. And you simulate a funded challenge if you want to do funded trading, right? You open up a 100K paper trading account on TradingView. It's free and it takes 2 seconds to do. And you just pick a prop firm, you go through the rules, you basically pretend like that 100K paper trading account is a prop firm account. 5% max daily loss, 10% max overall loss, 10% first phase goal, 5% second phase goal. Don't trade 2 minutes within news, whatever rules, it's just an example. Follow that. And if you can pass it and everything is aligning, congratulations, you actually did the work. Now comes the hard part. What you did previously was more annoying. It was more like a chore. But now the hard part is actually making sure you translate that into a real account. Buy the account. Invest the $500 into the 100K account. Feel the emotion. Understand if you lose the account, you lose that money. It also does help to mentally realize I'm buying the account, the money is gone. That'll help quite a lot, right? Or just buying multiple smaller accounts so that you give yourself the chance to actually lose the accounts and lose the emotion. Anyways, there's different tricks. You guys get the point. Understanding the psychology is one thing, but if you don't actually have a good edge, if you don't actually have numbers and practice doing the right things over and over, you're going to fail. It's that simple. The turning point wasn't finding a better strategy. It was discovering this one principle that changed everything. And a lot of that is just risk management. It's really that simple. So let's say I just pull up a pair which represents NASDAQ, okay? Whenever I was younger, whenever I was in my early trading years, I didn't quite understand how to actually risk properly. And this screwed me over big time because I would think that a very small move, right? Maybe this little move right here could maybe only make me $10. Meanwhile, this big move down could make me $1,000. I did not understand position sizing. And I'm going to explain it to you guys in a very simple way. Trading panel, paper trading, connect. Let's go create account, $100,000 account. I'm just going to put a random, it doesn't matter. You guys can set your leverage, which is very useful. You guys can set your commissions, very useful. Just like that, took me 2 seconds, I made that. Now let's go ahead and simulate this, all right? Let's simulate a short position from here with a stop loss here and a take profit here. Once again, completely random, just as an example. Right click, create limit order. You guys can see in this case over here, if you go to percentage balance, you set that to 1%. Sorry, you set that to percentage risk. If you set it to percentage risk, set that to 1%, you'll see one thing changed, the units. In other words, the position sizing. In other words, how much you're going in with. In other words, margin, bunch of different names. The stop loss, the entry, the take profit is still the same. Still based off this little position tool. Yet now we're risking 1%. What if I were to change that to 1.5%? Just like that, nothing changed, except this number got a bit bigger. And now I'm risking 1.5% to make 2.8. 1,500 to make 2,800. What if I wanted to risk 0.5%? Just like that, risking 500, which is 0.5%, 100K, to make 1K. You guys get the point, right? But Seb, what about this way bigger move? All right, well, let's just test it out. Let's close this out. Then let's go ahead and grab a short position tool, let's say right here, with our stop loss right here. And let's say our take profit over here. Let's right click, create limit order, and let's set this to 1%. You can see right here, we're risking 1% or 1K to make 5K. But Seb, this clearly makes you more money, right? It's a much bigger move, only due to risk reward. The position sizing, as you guys can see, 74, which is actually a lot less. If I were to change this to the exact same risk to reward, right? 1.86, right here, 1.86. As you guys can see, we'd be risking 1% to make 1.87. Meanwhile, this is a significantly bigger move, 25 points versus 16 points. Now, what if we were to do the opposite? What if we were to have, let's say, our entry here, stop loss here, and let's say 2 risk to reward. This is a much bigger move. This is 50 points. We're risking 1% to make 2%. What if over here you had a better entry, right? A tighter stop loss
and you had your take profit all the way down here. Just like that, our take profit is 20 points. Meanwhile, over here, it's 50 points. This one, you'd be risking 1% to make 5%. Meanwhile, this one, which is way bigger, you'd be risking 1% to make 2%. This is where position sizing comes in. And my realization was, I don't need to use these weird position size calculation spreadsheets or weird EAs on MetaTrader. If I can just find a way to trade straight from TradingView, I can make this calculation in 2 seconds. Now, the reason why this matters more than anything else is because, well, we're basically talking about risk reward. And risk reward matters so much more than win rate, because if you have a 90% win rate, but you always set your stop loss way out there and your take profit's always tiny like this, well, it seems okay whenever you think about it, right? Because you're probably going to take a couple of trades and they're probably all going to work out. So you're going to be like, hey, I have a 100% win rate. I'm killing it. But the problem is you're risking $1,000 to make $138. And the day where that goes against you and you were to have done something similar, maybe you got in over here expecting a nice small move, and then you had your stop loss all the way down here. And in this case, you got stopped out. You entered here, it went into profits, and then boom, you got taken out. You're going to lose. In this case, if it was a 0.1 risk to reward, which would look like this, in other words, you're risking 1% to make 0.1%. If you had gotten 9 wins in a row, 9 wins, 100% win rate at that point, and you got 1 loss like this, you actually lost money, which is crazy. You actually lost 0.1%, which doesn't sound like much, right? But you're losing money with a 90% win rate. And if your next trade was to be another loss like this, you would have lost even more. The problem is, it's not like you're going to be risking 1% on this, because making 0.1% means nothing. You're going to be risking 10% or 100% of your account, which means if you lose basically everything. And that right there is one of the biggest things that you need to avoid in trading if you want to succeed, because win rate is very useful to have at a higher point, like 60, 70, 80%, because it helps with psychology. But it means nothing if one losing trade wipes out all of your wins. It needs to be balanced. Now, whenever we talk about trading results, performance, etc., this realization did help me a lot, because before, like I said, I was just all over the zero DTE options. I was basically risking my whole account, or at least a very large amount of my account, not understanding how to use a position size calculator or risk management, because I was using stock options and I had no fucking idea what I was doing. Case in point, everything changed for me when I switched from options and I went into leverage trading crypto, because at that point, I could actually set my stop loss based off the price I saw on TradingView. I could actually learn technical analysis, learn patterns, learn indicators, and I could start to build some sort of market analysis, some sort of market intuition, as opposed to, I should just long here because Tesla's going up a bit. Right? So this changed a lot of things for me, because instead of putting $1,000 into my account and losing it within a few days, I was actually keeping the money in my account for weeks and weeks and weeks on end. And occasionally I would lose maybe 10, 20, 30% of the account from losing streaks, but at least it wouldn't be 100%. And I could actually review things more clearly. When my losses came, I wasn't as stressed out, because I knew I wasn't going to blow 20% of my net worth just out of nowhere. I was only going to be losing a smaller amount. And I was more focused in on the trading than anything else. And like I said, guys, psychology is one of the biggest things. Data and psychology. Data, obviously, you need, but psychology, if you have your psychology all over the place, it's not going to do anything good for you. If you're risking way too much, or you don't know what you're risking, or you're constantly changing your risk, in other words, you go from 1% to 5% to 20% risk just because you're trying to make up for losses or scale up an account and you don't really know what you're doing, your psychology is going to be out of the window, right? Whether you have a 50% win rate or a 99% win rate, it doesn't matter if your psychology is not in check. How do you get your psychology in check? Knowing you're not going to lose too much, and whenever you win, well, it's based off your plan. But here's what nobody tells you about trading. Even with perfect risk management, you'll still fail without understanding this. Market context is everything, guys. When I say everything, I really mean everything. If you don't know where the fuck you are in the markets, what the hell is going on, you are going to have a really hard time. Can somebody tell me what the difference is between this point and this point and this point and where we are today, right here? What's the difference between these two periods? Well, I'll just highlight a little bit clearer like this. What's the difference, guys? Can I get a comment? It's not like I can read the comments right now anyways. I'm from the past. Can somebody tell me? It's simple, guys. From the 19th of February 2025 to the 8th of April 2025, the market was going down. Right? Over 50 days, it was going down and down and down and down and down. Now, what about the 8th of April all the way to today, the 28th of July 2025? What's the difference? For the last 100-something days, we've been going up and up and up. That's called a market condition shift. We go from a downtrend into an uptrend. So if you were just randomly shorting the markets, short over here, well, you would have been making money for quite a long time, over and over and over again. Had you kept shorting every single time that you had a bit of a pullback over here, you would have been losing all of the profits over here and then some every single day because we've just been going higher and higher. Now, what if you've only been used to trading all the way down or all the way up? What about this period right here, right? The 11th of December to the 19th of February 2025. What would you have done here? Well, you could have performed potentially, right? There was some volatility, but overall we were quite sideways. We weren't moving that much. We were just going boop, 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 boop. And that's that. So if you're only used to massive volatility, either to the downside or to the upside, and you cannot trade a sideways market, so you don't know what to do when you're in a sideways market, you are going to struggle. If you only know how to trade a sideways market, you're not going to do very well in a volatile market, whether it's the downside or the upside. I'm not going to keep rambling about this because you guys get the point. You need to know how to adapt to different market conditions, whether you're trading Bitcoin, the NASDAQ, Tesla. You need to be aware when a big shift is coming, because whether you're trading the 1 minute or the 4 hour, the major market uptrend or downtrend or sideways, directional bias is going to affect you, whether you like it or not. All right. Because if the market is going down in the 1 minute, it's probably going down on the daily, unless we're talking about a very, very, very small move. Now, there's a really easy way to determine what kind of market you're in, and it's called using your eyes. I mean, you could just go on the daily and you can see that we're actually going up heavily or down heavily. But if you're going to zoom in like into the short term, you might wonder, okay, are we actually in an uptrend right now or a downtrend? Well, in this case, we're obviously in an uptrend because we've just been making all-time high after all-time high, but certain markets are a little bit more difficult. Now, there's different ways that you can kind of see whether we're in an uptrend or downtrend. You could use something like moving average exponential, and you can throw on, a length of 20 right here. A 20 EMA is typically going to give you a decent idea whether you're in an uptrend or a downtrend. Now, I'm not saying as soon as we go below or as soon as we go above, the market's totally shifted, but it is going to give you a general idea in case you're curious. So as you can see right now, we've mostly been going up. Now, you can use a 20 or a 50 or a 200. You can use many different EMAs. This is just an example, once again. But this is what a 50 would look like. It's more smooth. It's more higher time frame. You can see overall, as soon as you broke below this, we were downtrend, 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 downtrend. It's only after we broke above this that we were more considered into an uptrend if you were to look at this, right? Now, there's some periods where if you're really going sideways, it's going to be more confusing like this, but that's where you can just use your discretion. That's where you can use your back testing, your analysis to figure out yourself based off of whatever time frame you're trading, whether you should be looking for more longs or shorts. Sometimes it doesn't matter. If you have an edge where it doesn't actually really matter that much and you haven't noticed a big difference, whether you're back testing or live forward testing or just trading, if that's the case and market conditions don't matter, then good for you. But for most people, it is going to matter, and it is something to consider. If this month we've been going up and last month we were sideways, you're noticing a big difference in results between last month and this month, maybe look at the market conditions and see if there's anything you can adapt. Now, the main way for you to adapt and, be ready for these kinds of shifts is to make sure that you don't just back test one pair. Right? That whenever you are back testing, if you've, let's say, only looked at NASDAQ over 2 years, maybe journaled, back tested 200, 300 trades, at that point, you're potentially going to be good and notice that it doesn't matter too much. Or you're going to notice, wow, I have big periods of drawdown or big periods where I massively outperform or periods where I'm just confused what's going to happen next. If you're going to be looking at NASDAQ, maybe you could also look at another pair. It could be maybe the S&P 500 or something that's uncorrelated. It could be a currency pair like Euro USD or even GBP Canadian dollar. Like, it doesn't really matter. So long as you have something that's going to move differently, you are going to be able to always have opportunity, because it's not always just about the pair. Sometimes it's also just about the kind of market structure and overall market direction we are in. Before I dive deeper into the exact strategies that made me finally profitable, if you want my personal help becoming disgustingly consistent like my students, click the first link in the description and book a call. There's a completely free course in the description too. Now keep watching, because I'm about to reveal how I went from scattered results to consistently profitable strategies that outperform everything you've seen on YouTube. So look, once I understood market context, my results improved, but I was still drowning in noise. I had to test dozens of strategies before realizing that the most profitable ones were actually simpler than anything I had seen on YouTube. Now, look guys, there's a lot of strategies that work. I'm not going to lie to you and tell you that only my strategy works. That's not the case, guys. Like, anything that has data and that is sensible and works in multiple market conditions over a long period of time works, okay? And it can be profitable. So I'm just going to go ahead and give you an example of the kind of trades that I like to take. Now I'm going to stop over to NQ actually, because I have this marked out pretty nicely. So we made what's called a new weekly opening gap over here from Friday to Sunday. It's a gap that we made over the weekend because there's no trading over the weekend. So anyways, we made this gap over here. Then we ended up breaking lower over here. We reject the top, held the mid zone, rejected the top going to market open. And then we had this move all the way down here. So the reason why this is interesting to me is because right here we had what's called a S and F trade. Okay, this is one of the strategies that I teach within SCT. So this is over here, a bit of liquidity. Why would I pay attention to this? Because this is the pre-market high that we made right here, right before we had our market open. So we made this high, rejected the top of the weekly opening gap, and then we had this rejection lower, made a lot of space. So it's natural for us to come back up over here. And then over here, you'd look into the 1 minute time frame to see a fair value gap and an inversion. Did I just move that alert? It doesn't matter. So as you guys can see, first things first, we have liquidity right here. We take it out. Now we have a fair value gap down here. It's not quite super close, right? Not quite as I would like, and it doesn't get inverted. Then we have this new high, which gets taken out. This is called a double sweep. And this is actually really good. Whenever this happens, usually it means that we're kind of like struggling to slow down and reverse, but we are most likely going to reverse. Another way for you to see kind of what I mean is that you have high, 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 high. Meanwhile, over here in the RSI, you have high, lower high, lower high, lower high. This is called a RSI divergence. In other words, the strength is going down while the markets are still going up. I don't really need to look at the RSI to tell at this point, but sometimes it can help, right? Especially whenever you're starting out to notice these things. So we're pretty much starting to top out here and reject. Now, what will your target be? Well, it could be, of course, this low or this low, but the best target would be the new weekly opening gap, right? The opening of it, because we hadn't filled it yet. So in this kind of case, you'd be looking for the nearest fair value gap, which in this case, really kind of choppy morning, to be fair, like a lot of big wicks. So this would be the best fair value gap that you have, which in this case gets inverted right here. So you would just enter straight out the inversion, set your stops here, and your take profit could be down here. And this would be a classic trade. Entry, stop loss, take profit. You get 2.5 R. In this case, you need to have your stop loss at the swing high, absolutely, because as you guys can see, we came back up after the entry, went almost 60% of the way towards our stop loss, and then we did go lower. Why did this happen? Because we rejected the top of the new weekly opening gap, and we were going into a premium right over here, as you can see, above the 0.5 before we ended up having this rejection lower. We also came to this order block, blah, blah, blah. You guys get the point. This is just an example of the kind of trade that I like to take. And I did take a trade this morning, to be fair. I took a trade on the way up, a very short trade, just going into this new weekly opening up, and I made about $2,000 on that. Let me go ahead and just show you guys what that trade looked like. It was a pretty easy trade. It really wasn't anything too crazy. Made $1,686. I don't know if you guys can see that, but that's my 400K funded account. So the reason why this works across many different markets and why I fucking love this strategy is because it's just based off of a pattern in a sense, right? It's just based off of something which repeats in every single market no matter what. A high gets made, a low gets made. We make our way towards the mid zone. The high is liquidity, the low is liquidity. Now this could be the Asia high, this could be the London lows. It doesn't really matter. I just look at liquidity. Of course, you could backtest it however you prefer. It's better if it's a market session. Now, whether you're looking at something like the 1 hour time frame, the daily time frame, the 1 minute time frame, whether you're looking at NASDAQ, Bitcoin, XLM, or EURUSD or XAUUSD, it doesn't matter. Now you have the high, you have the low. Let's say we're in the mid zone right now. Then we go into New York session. It could be any time, but New York session is usually gonna be pretty good for this kind of pair like NASDAQ. But I've taken trades between sessions and gotten 5R within a few minutes. So this works very well. So anyways, let's say that we go down here and then we start to come back up. So we take out the liquidity and we start to go up. On the lower time frames over here, you might have a very small fair value gap, right? In this case, a bearish fair value gap. As soon as we close above it, there'd be an inversion of the fair value gap. It'd be as simple as just entering right here with your stop loss at the swing low, and then your take profit could be over here, which would be the like mid zone liquidity or the top liquidity, right? And then guess what, guys? If we were to go over here and do the same thing, you could take a short down to this level again, right? And have taken profits already on this move. Or if we go all the way up here, once again, exact same thing. So as soon as one liquidity level gets hit, you get a trade. Once you get your take profit hit or stop loss, depending on what happens, you can usually just enter into a trade right after. And usually you're going to be able to just get more and more profit or make up for a loss right away. Now, like I said, this can work easily on Bitcoin on the daily, as we've seen in our back tests, or on NASDAQ on the 1 minute during New York session, or on gold on the 1 minute during Asia session. Or it could be on the 5 minute with NASDAQ during any session, or it could be on Euro USD on the 15 minutes. It really doesn't matter because, like I said, fair value gaps can be in any sort of time frame. Liquidity can be built on any time frame and identified on any time frame. It just depends how you want to trade it. I like to trade the 1 minute because it gives me the cleanest entry as close as possible to the actual reversal from the liquidity sweep, and typically I'm able to use new weekly opening gaps really efficiently, which I fucking love these. I fucking love these things. Now, whenever it comes down to like win rate and risk to reward ratios, it could be literally anything that you want. Like I've said before, I've hit many 5-hour trades with this. Really nice big 5, 6, 7-hour trades. I've even had a 30-hour trade on gold from a 1 minute SNF play, but typically I like to aim for right around the 2 risk to reward mark. This is a 2.5 going to this level. Could have just went for a flat 2, but makes a lot more sense to go for this considering how clear our take profit is. And there's different ways to go about it. You could, in this case, for example, look for a limit order into your original fair value gap. So instead of entering on the candle close, you could wait for a retest. I have back tested and I've seen this works pretty well. So that instantly makes your risk to reward move up by like 1.2. You could also incorporate other concepts. In this case, you could have been looking for a rejection of this new weekly opening gap. So that would have given you 7 risk to reward for the same setup. Same take profit, same stop loss, just a different entry, right? So different ways to go about it. Once again, you just need to back test and you'll be good, because sometimes you'll miss the entry if you do this kind of thing as opposed to just a market entry. And that's risk to reward. Now, win rate's going to always fluctuate, but I've seen anything between 40 to 80%. I'm seeing more 60% on my end, but I've seen many people doing it on the 5 minute with NASDAQ, getting around 77% win rates within the inner circle, which is really good to see, because getting 77% win rate with something like a 2-to-1 or even 3-to-1 risk to reward ratio is actually cracked. Now, the reason why we focus in on only a handful of strategies and why we don't have 30 million that we recommend each person learn is because one strategy is going to incorporate a couple different concepts. It could be liquidity, could be time frames, it could be a fair value gap, it could be an inverted fair value gap, it could be premium discount, it could be new weekly opening gap. There's so many different concepts you can use. If you limit your strategy to like 3 to 5 concepts, so that you, once again, don't have to overcomplicate things like options, so that whenever you are trading, you don't have this weird like jumble mix of this tells me to short and this tells me to long and this tells me to wait. It's going to make it easier for you to execute. And in the end, if you have, let's say, 3 strategies that you're trying to trade at the same time, in the end, it's going to happen that your strategies clash and you're going to confuse yourself. Like, I could have looked at a million different things over here to grab a short or to even argue for a long. Like I said, there's a million things that you could have been looking at. And the problem is that there's so much information out there. That's the issue with the internet, is that there's so much out there, so much information, so many opportunities for you to confuse yourself that it's hard for you to just find one thing and stick to it. So, just take my word for it, or don't waste months, years, and also thousands or tens of thousands of dollars of your own money. My point is, if you backtest, if you study a strategy and you're doing well with it and it's simple, stick to it. If you haven't found that yet, then just hit me up in my IG DMs or in the YouTube comments and I'll try to help you figure that out. Because like I said, this strategy that I just gave you guys, the blueprint of, you can easily teach anybody. You can easily learn, like in 5 minutes realistically, because all it takes is the understanding of a few simple concepts and you can apply it to any market. Like with what I just gave you guys, you can get funded tomorrow. You guys can get a payout this month. You guys can do anything with it, right? And it's simple. It's a strategy which you could learn for free anywhere. The issue is, will you actually take time to back test it properly? Will you actually be trading in live markets the same way as I just showed you, or the same way that you back tested, which I hope you did, right? Will you actually be following a plan, or will you make a bunch of mistakes, or are you even going to journal? Are you going to use a demon finder? Are you going to do your weekly reviews? That is the hard part. But then again, having a strategy means nothing if you don't know how to execute it properly. So let me show you what actual execution looks like. Now, there's a couple of different ways that I figure out and I decide what I actually want to trade. So with this setup over here, in some days I might take it, other days I might not, depending on where the fair value gap actually forms, right? Where the liquidity sweep happens, etc. Now, if I were to go onto the 5 minute over here, right? And I were to look, for example, at this massive liquidity sweep we had, well, you could have potentially looked at this low, right, from the last candle before the market closed last week. And you could have said, okay, this is liquidity. The problem is, going into this level right here, we made 1, 2, 3 fair value gaps. So even if you were to have entered, let's say based off of this inversion right here, you would have been entering over, let's see exactly how far, over 40 points away, right? Exactly half of the new weekly opening gap away from where we actually swept, which is not ideal. So the only way you could have fixed this is by just going down into a super low time frame, which I don't really recommend you do, realistically, and then gotten a better entry. So in this case, there's only one fair value gap, only one here. Which in this scenario, you could have literally just gone in right here, stops right here, very tight stop of 17 points, and just taken profits over here at these relatively equal highs for 2.5 R, closing the trade from 9:21 to 9:51, 30 minutes. So that would have given you a setup, but in the 1 minute, it did not. And on the 5 minute, well, you had this fair value gap. You had this fair value gap, but the problem is we only inverted it all the way up here. So still the exact same issue as earlier. You're getting a super late entry. And if you were to take this, let's just go ahead and take it for the sake of argument. So your stop loss all the way down here. Your stop's at 50 points, which means for just 2R, you would need to set your take profit at 100 points, which would in this case be above London highs, which is not ideal because we could easily just take that out and then go lower. So lots of issues with this, right? Lots of issues. Now, would you have gotten stopped out on this? Well, technically not yet. You'd be right around entry right now, and this could play out, but this other setup on the lower time frame played out way faster. What I would have done personally is just not taken it because the entry is way too late. There's plenty of liquidity sweeps that happen every single day, so there's no need for me to try to force anything. Now, whenever it comes down to entries and exits, honestly, like I said earlier, for example, with this setup, which occurred in New York AM, there was only a fair value gap down here. This is when the inversion happened. It was a little bit far away from your liquidity sweep area, but it wasn't too bad, right? So your entry could have just been here, could have been where we actually inverted the fair value gap, where the fair value gap is, or it could be, going into some sort of rejection of the new weekly opening gap level, or just going into premium. It really doesn't matter too much. That is something that you can figure out what works best. In this case, for me, I just like to enter as soon as the inversion happens, set my stop at the swing high, and go for a flat 2R or more, depending on what I'm actually aiming for. And that's worked really well for me. You only need to have a 50% win rate, more or less, and at least a 2-to-1 risk reward ratio for you to be highly profitable. Honestly, with that, you'll be cooking. If you can get better than that, amazing, right? But no need to force it. So I know that for myself, it's better if I just take the trade here, stop loss at a safe spot, take profit at a reasonable spot, and I let it do its thing, versus me potentially missing the trade and being very annoyed about that. Because if I've just lost 2 trades in a row and then I'm missing this trade, which would have been a win and made up for those, and I take a loss after, it's really going to impact my psychology. Unless, of course, I've just backtested and fully decided to only take trades based off the retest. Then that would be different. Then in terms of exit, honestly, all you should do is just set your take profit and call it a day. As soon as it hits, you're good. Stop loss or take profit. Don't get more complicated than that. If you are noticing that you're going like this close to your take profit and it starts to reverse, you could close it out if it's hitting some sort of important level. If you're only halfway to your take profit and you close it out there for no reason, I don't know what the fuck you're doing. You clearly didn't do your analysis correctly. You didn't plan for it accurately. But if you're like 1.95 out of 2R, just close it. All right. There's no point for you to try to nudge out a little bit extra, because as I've talked about many times before, if you're that close to 2R, all right, this would be a good example. Let's say like this. If you get it over here, and it comes down to your profit, and then in this case, right, we come super close to your take profit, and then we close the trade right here, right at the mid zone, you could close that out. You would have a good enough reason to close that out, because we might just bounce off the mid zone like we did over here and then make a new high. So at that point, it would actually be reasonable, because you'd be closing it out for like 1.5R, which, let's go ahead and just explain why it's better to close it out. If you were to decide not to close out the trade, it's basically the same as you closing the trade and then re-entering at this point. Entry, stop loss, take profit. 0.22R. Risking 45 points for only 10 points. Doesn't make much sense. If you were to close the trade and reopen it, the same stop loss and the original take profit, you wouldn't. That's my point. You just wouldn't. All right? So obviously, backtest. Make sure that your backtest actually is thorough and makes sense, and you'll be able to avoid these kinds of situations, but occasionally you will need that kind of discretion, and what I just gave you is a pretty decent framework to help with that. It's called Evolving R. Order types can be something that's really important. If you're looking to enter right away, you need to just grab a market order. Fuck the fees, forget about the fees. You'll pay a little bit more with market orders than limit orders, but typically with a lot of prop firms, it doesn't even matter. So you shouldn't even be thinking about that, but whenever I used to trade crypto, sometimes I used to think about that. So markets, you should always use if you need to get in right away. do not hesitate, just get in, okay? Limit orders are very useful, but you can get sidelined, okay? If you know you should be getting to NASDAQ right now, right, then just get in right now with a market order, right? If you know you're not supposed to get in right now, then don't try to just time the market perfectly. Set a limit order, set and forget, right? Set your stop loss, set your take profit, and you're good, all right? Make sure your risk is accurate, and you're chilling, all right? That's your trade. But if your idler telling you get in right now, guess what you should do? Get in right now. This is going to cost you a lot of money if you get sidelined on trades where you're actually supposed to be getting in. Or if you're getting into trades when you're not supposed to, well, you're going to be feeling real stupid because you're probably going to get stopped out or just going to make a heck of a lot less than what you should be.
Not much. Now, here's where most traders mess up. They have the strategy, they know the execution, but they're using outdated tools and methods. Now, guys, there's a million ways for you to actually trade. You can trade straight off TradingView. You can use MetaTrader, which I would say is outdated at this point. You could use something like TradeLocker, NinjaTrader, also kind of outdated. Tradevate, which is a bit newer, or even some other platforms like TopStep, which is a futures platform, or, well, you could use just about any platform out there so long as it actually works for you. But something like MetaTrader 5 or MetaTrader 4, I find is counterproductive for most people. Now, let me ask you a question. If you've been using MetaTrader, whether you've been trading for a few days, weeks, months, or years, why do you use MetaTrader? Now look, if you're in a remote region, maybe in Nigeria where you don't have the best internet, and you're struggling with being able to place your orders, and a certain platform like TradeLocker or even TradingView doesn't load super well for you, main reason why, because it requires a lot of bandwidth, then sure, if you get used to MetaTrader and you're able to calculate your position sizes and you don't make any actual mistakes from that, then great, it's fine, right? But most of you, I would hope, are not in Nigeria, all right? And if you are, and you have the funds, I would highly suggest that you get yourself some solar panels so that your electricity is going to be stable, and you have Starlink, or at least some sort of really, really reliable way of having internet or data that's not going to make you use a platform which sucks. The main reason why MetaTrader sucks, you cannot calculate your position sizes very easily. There is no easy position size calculation. The best you can do is just enter with a lot size, hope it works, and then drag your take profit stop loss and see how much you're going to be risking, which is going to cause you a lot of problems. So that's why I highly recommend trading straight from TradingView, because like I showed you guys before, you're able to calculate your risk in 2 seconds. It makes your life way easier. And if you're able to calculate your risk very quickly, you're able to trade quickly, and you have all of your charts, all of your indicators, all of your analysis, all of your presets, all of the tools in one place, dude, your life's just gonna be so much easier. So I highly suggest just trading straight from TradingView. But now some of you might be thinking, Seb, okay, but how do I do that? Like, if I go to Trading Panel, my guy, and I scroll through here, I'm not gonna know like which one of these to use. And even if I do know which one to use, I'm probably not gonna see it in here. Right, I don't see no TradeLocker. I don't see no CTrader. Where is it? Well, it is not that simple, right? You need to use some sort of like intermediary, some sort of like middleman in a way, like a platform which is going to actually allow you to trade straight from TradingView, and in some cases even have your risk preset for you. If you want to know how I do this, you can just DM me on Instagram. The link's going to be in the description, and I can explain it a little bit more depth. But nonetheless, this is what I recommend doing so that you can trade straight from TradingView, and once again, your life is just way easier. And yes, you can trade straight from your computer, straight from your phone, straight from literally any sort of device that supports TradingView, because the trading panel, your connection to your broker, to your prop firm, is always going to stay there, right? In worst case, it just takes you 2 seconds to log back in. You're able to see all of your positions, manage them easily. You have all of your alerts. You get the point. TradingView is the best. Now, even with the right strategies and execution dialed in, none of that matters unless you're prepared each day. Let me show you exactly how I structure my trading day and why most of my real work happens before the market even opens. My morning routine is very simple, guys. If I'm going to be trading the New York Open, which unfortunately for me is 7:30 a.m., then I make sure not to wake up at 7:25 a.m. I wake up quite a bit before that. Now, that could be all the way back at 6 a.m. It could be 6:30, it could be 6:45. I'm quite good at this point. I don't need anybody to babysit me, or I don't need a whole lot of time to, wake up and handle my stuff. So 6:45 for me is quite good. You'll notice this is about 45 minutes before the market opens, which gives me about 15 minutes to wake up, hop on my computer and look at the charts. In other words, I'm going to have roughly about 30 minutes until the market opens. Now, is this going to be enough time for me to get ready? Absolutely. Here's what I do, right? I take my first 15 minutes to wake up. What does that mean? Brush my teeth, whatever, make a tea, like very basic stuff, just so that I'm ready, I'm relaxed, and I take a couple of breaths before I open up my computer and go into the stress bomb that is technology these days. So once I do hop onto the charts, the first thing I do is I look at the higher time frame to see what the heck's going on. So in this case, you know, the daily, the 4 hour, the 1 hour, they don't really tell me a whole lot that's too important. If we go back to NQ, you're going to be able to see this gap over here that I think we were talking about already right here. So we made this new weekly opening gap right here. If I go down to the 15-minute, you'll be able to see that previously on Monday, we filled it and then we tapped the bottom. One above, we held it, and just like that, we took out London highs, then we held London highs, then we had one more move up before we ended up going all the way back down, held the bottom to the top, went to the mid zone, went to the top, took out this liquidity, and then went down here. And that's the main move that we ended up seeing. Now, the main thing that I would have noticed, of course, going into market open, so once again, I'd be looking at the market here, is obviously this high over here, right? So notice we had London highs, we took it out, didn't do a whole lot. Then we took out the high that we made over here from that London session, took it out, didn't really do a whole lot, just held this level, then took that shit out again. So this just tells me that we are consolidating within an area. We've already filled a new weekly opening gap, but that doesn't mean that we're not going to go for these relatively equal lows, which is easy liquidity. And just like that, going into market open, let's go to the 5-minute. You'll be able to see that we hit right into that level. Then you'd go down to the 1-minute. I showed you guys this exact setup before. You wait for an inversion of fair value gap. In this case, you just wait. There's one literally right here, which is pretty nice. We do have this fair value gap all the way up top as well. Now, there's a few things you could do. You could just wait for us to make our way back below this liquidity level, or you could just get in once an inversion occurs. In this case, I would not take this inversion. I would wait for this one right here, which happens here. You'd be able to just take the trade here, stop loss here, and then take profit. Could be for 2RR, or it could be all the way down to the level that we were just speaking of. Now, realistically, I would set my take profit here for 3R, because that's where we have these Asia lows, and in this situation, you get your take profit pretty easily. You could also hold some runners going into these lows, but I think this would be a really good play. And you don't want to fuck with the market too much whenever you're in this kind of position where you're entering based off of this massive move. We did have a strong displacement to the level, but we are getting inversions, right? Especially when we're coming into this new weekly opening gap and we showed that this thing was support. You don't know how far we're going to go up or down in a single day. So that would be an example of how I would play this, and the main reason why I'd be able to trade this properly is because I didn't hop on right as market open happened. Had I done that, I would maybe not have even paid attention to this liquidity level because, you know, as soon as I would hop on at like 7:30 or 7:35, we would have already gone through this level, right? Which means I would have totally missed this trade, and then I would have just noticed maybe an hour later and been like, oh shit. So it really is as simple as just wake up, make sure you're relaxed. You're going to miss certain things if you don't wake up at least 30 minutes before the market open, but ideally 45, so you have 15 minutes to wake up, do human stuff, and then half an hour to really ponder in the markets, set your alerts, and then you can just walk away until your alerts get hit. It really is that easy. And also, speaking of which, like, you never really know what's going to happen in the market. We could have opened over here and then gone straight down, or we could have just gone significantly higher. Like, you don't know what's going to happen, which is why you just need to prepare for different situations. You need to take a look at the different liquidity levels that we have, see if we have any important reactions, and once again, go into the higher time frames and see kind of where we're at. In this case, not too much that you can do. We're at all-time highs with NASDAQ, but you could pretty easily see that we, fully filled this gap, made a higher move, created swing failure over here at the 7 a.m. candle, and then this is the 1 hour. So within the first 30 minutes of market open, so massive swing rejection. Case in point, you can see that we ended up taking out this liquidity, rejected massively, and we do have a very clear target being these lows right here, right? Now, are they going to be fully swept? Maybe, maybe not. That's not really the point. Point is, you do have a clear target, and in this case, we ended up tapping, went up, rejected, and then fully swept. So if your original target was here and you were just barely missing it, you had two options like we've said before. One option would have been just to take your profits right there for basically all of the main risk to reward you were looking for. You were like 0-1 away. Or you could have just held your plan and waited until this was hit. You could have even added into the position as we were rejecting here. For example, over here, made liquidity, swept, and just like that, you had yourself a nice play. So many trades available. Thanks to my experience, when the market opens, I'm not scrambling. I'm waiting for specific conditions that I've already identified. Whenever I'm looking at the charts, I know exactly what it is that I want to see happen. If it doesn't happen, then great, no trade, easy peasy. If it does happen, I'll be staring at the charts like a hawk so that I can actually take the play at the right time and not be a minute late
and be 1-to-1 risk to reward lower than I should be. Now, there's a really important topic which I think I should bring up, and that's trading hours or trading sessions. As you can see, there's New York, there's London, there's Asia, there's so many different sessions out there. Now, I know a lot of people which like to limit their actual trading time to either a full session, but usually a specific amount of time or range within a session. It could be 9:30 a.m. EST, the first minute within the market open, to the last 60 seconds. I know a lot of people which like to start trading as soon as the market opens, and then they close their trading session 1 hour later, 9:30 to 10:30 a.m. EST, and that's it, that's all, right? That doesn't mean that they close all their trades by then. It just means that they're done actually entering trades and managing them. They just kind of let them do their thing. So if there's no entries that occur within this time, they don't actually do anything at all. They just walk away and wait until the next day. If, for example, I took a trade during this time and then I were to hold a position for multiple hours, I just wouldn't be staring at the charts the whole time. That's the main thing. Now, the main reason why it's recommended to do this and to actually limit the amount of time that you're staring at the charts and placing trades is because if you don't actually set a limitation yourself, you are naturally going to fall into most likely bad habits like over trading. So you could very easily just be staring at the charts all day, which all day is pretty long. That'd be 7:30 all the way to 2 p.m. my time. That's like a full shift. At that point, just go get a regular job. You're probably gonna make more that way realistically. You're gonna take a bunch of trades, and in the end, if you were to look at your original plan, let's say the first hour and a half of the markets being open, and you miss the trade, and then you're staring at the charts for hours and hours on end, you could potentially find more setups. But if it's not what you backtested, if it's not exactly what you typically do or what you're supposed to do, you're probably going to get ping-ponged in the worst way possible. Obviously, this looks clean in hindsight. We hit the bottom, hit the top, then over here we come down into a deep discount, then over here we hit the top, and then we eventually go all the way down. This seems like there's plenty of opportunities, and that may be true, but whenever you're tunnel visioned and you are full of emotion and you're clouded, for example, like you should have made a bunch of profits here, but you didn't, so you are going to take a bunch of trades here and lose a bunch of money, you're most likely going to lose money in the situation, right? And sometimes price action after a big move like that's not going to be super clean, right? If you were to look at it over here, it's not always going to be, sunshine and rainbows. In this case, not too bad, right? So you did have this fair value gap right here, which as soon as it inverted, it did give you a pretty decent play going up into this level over here. And then in this case right here, this original fair value gap ended up being held. We closed out of it right here, and this could have given you a long entry, stop loss, take profit up here. And then as soon as we swept this liquidity, this high, and this high over here, you could have just gone ahead and taken a short based off of us inverting a fair value gap, which in this case seems like we had already inverted this little guy. But I don't know if you would have had the confirmation, right? So at this point, you would have had confirmation to get in, or you could have waited for a market structure shift, which happens right here, which gives you this massive move. So yeah, you could get some good setups over here, but realistically, like I said, you're most likely not going to actually trade properly if you were clouded. So for your own good, I would recommend that you spend maybe 30 minutes, an hour, or latest, or at the most 2 hours per day staring at the charts, placing trades. But even then, I try to only spend maybe 10 minutes looking at the charts every day, maximum. I check on my phone, check on my computer, set my levels, set my alerts. Once those alerts get hit, that's when I actually spend more time waiting for my entry. And then as soon as I'm in, I literally just walk away. There's no reason for me to look at the charts. I just basically set and forget. Now, if you are in a position where, you are in a trade and you want to maybe find more trades, or you want to keep managing it, you might wonder, when do I stop for the day? Like, when do I stop taking trades? When do I stop managing? When should I just close and wait until the next day? That's going to be up to your data. Unfortunately, that's going to be my answer for just about anything. And if you don't know what that means and you don't know how to handle that answer, you're probably not trading right now. You're probably gambling. So you need to fix that. In other words, backtest, demo trade, journal everything, and make sure that you're on track with a reverse engineered goal, which hopefully you've already gotten. Nonetheless, if you want to have a general rule of thumb, I would say no more than 2 trades per day. And I mean, if you hit a loss and then another loss, I think it's pretty obvious you should not be going for more trades. Whether or not you're going to be able to recover those losses or just get another one doesn't actually matter, because at that point, you're most likely going to be feeling some sort of emotion. And realistically speaking, as soon as you get 2 or 3 losses, it's pretty easy to get a whole lot more after. All right. So what I would say for that, 2 maximum trades per day or maximum 3, just depends whether you're getting wins or losses. If you start off the day with a win, close the day off, you're good. If you start off the day with a loss, you can take one more trade. If it's a win, you can call it a that, right?
If it's a loss, definitely call it that. But the most important part of my day isn't trading, it's what happens after. Reviewing trades is so important. If I were to use this example over here of what we had for this trade, which I'll just go ahead and bring back the rough setup. Once again, we were looking at this fair value gap. That's the inversion. That's the stop. And then in this case, we could just go ahead and set the take profit to the top of this for about 3R. Whenever I'm reviewing this, the first thing that I do, right, is make sure that before I start reviewing, that I actually have properly made sure there's enough data, in other words, enough candlesticks, enough time that has passed after my exit. Because there's no point in me reviewing the trade as soon as I closed it. Why? How the fuck am I going to know if my levels were any good? Maybe you're already going to have a decent idea, but if you were to just enter into a trade and it goes straight to your TP or straight to your stop loss, it gives you no information. You need to wait until ideally the market session closes, which at this point it'd be very good for me to review because, well, the market's, it's been however many candles. It's been about, 6 hours, 21 candles of 15 minutes since my trade has actually closed. And we have clearly hit the take profit. We came nowhere near the actual stop loss. The entry was pretty clean as we saw. And we did see that we actually went to the mid zone, to the bottom of this new weekly opening gap, and actually a little bit lower. So this gave us all of the data that we actually needed to know whether or not my entry, stop loss, take profit, and timing were good. So what I would do in this kind of situation is, once again, make sure you have a screenshot that's actually inside of your journal. So before your trade, as you're entering with your entire reasoning, the usual stuff, and then make sure that you have a nice clean screenshot. In this case, it could be off the 1 minute based off your entry so you can see very clearly like this, right? Make sure you actually have all the levels like the liquidity, the inversion, etc. Have it on the 1 minute so you can clearly see what happened in these levels based off your entry and everything. But the 5 minutes probably gonna be a little bit cleaner here. Make sure you have this previous trading data over here as well. And then I would notice, okay, cool. So we did hit this level, 3.3R. Great trade, exactly what I've backtested, no problems there. We bounced, rejected this fair value gap in this last low pre-break, went lower, hit this 0.5, went lower than the 0.5, came back up, roughly rejected it, came to this bottom right here of the new weekly opening gap. Then we ended up taking out this little low right here. We bounced up, went to the top. You guys get the point. Bounced around and then went a little bit lower and took out all of these lows, which we made 1, 2, 3, 4, 5. So you're looking at 3.3R for the setup. But if you had held some runners or held a take profit in the mid zone, it would have been 4.4 or all the way down here 5.7, right? You can look at different things. You can look at the entry, stop loss, take profit. You can look at the size. In this case, the size of the stop loss was very good considering the time frame. And then the actual size of the take profit for 180 points would actually be reasonable based off the volatility that we've been seeing, right? So these are the kind of things that you can journal, that you can review to see if you want to improve anything. I would say in the situation, 3.3R or 5.7, both are very good. There's obviously a decent difference of 2R, but you're not always going to get the full move, which is why backtesting is the most important. So you can journal these things and notice, hey, if over the last 30 trades that I've taken in the live markets, I've gotten, 1 or 2 more R than I've been used to based off my backtesting, then maybe go back to your backtest and review it again, because maybe you missed something, or maybe do another backtest, review everything, and then see, how did my take profit been at this other level, or for this fixed R, how much would I have made over the last month? It's a great exercise because you already have the data, and you're able to just kind of manipulate it based off of what you could have done. Not so that you can be like, oh, I should have done this, just so that you're like, oh, okay, now I actually have data to say that I should be doing this, taking profits earlier, taking profits later, entering at this time, exiting at this time, setting my stop loss like this. You guys get the point. And just like that, you'll notice instead of maybe 8R last month, you could have made 15R. And that makes a big, big, big difference, right? Anyways, that's what I would say is the most important whenever it comes down to reviewing your trades and your journal. It's just about figuring out exactly what you can improve in your day-to-day trading through your daily recaps, weekly recaps, and monthly recaps. With a solid daily routine, you'll start to see consistent growth, but turning a small account into serious profits, well, it brings its own set of challenges. Here's the realistic roadmap I use to scale my trading account, including the obstacles that nobody warns you about. One thing I've talked about in the past is the PDT rule, right? The pattern day trading rule. And you've definitely seen this talked about all over YouTube, especially if you're, into stock trading or if you've heard about it. Now, this is not something you actually have to worry about unless you are doing stock trading or options trading on a regulated broker. If that's what you're doing, then I'm sorry, but why? It's really not optimal. I talk about this inside of my free course because honestly, it's something I've seen too many people do, including myself. That's how I started, and it didn't work out well. All right, I lost like half my net worth, and I wasted a lot of time. So pattern day trader rule is not something you actually have to deal with, which is really good, because if you're using a prop firm like FTMO, or if you're in the US, maybe E8 markets, well, you're not gonna have to deal with that. at all. You can take 100 trades in a day and nobody's going to be complaining. Now, what I always recommend whenever you have smaller amounts of capital is not actually trying to scale up that capital, let's say with trading a small account, putting, let's say, $100 or $1,000 into a brokerage. What I would recommend actually is to utilize not a private account, but a funded account. Now, obviously you can scale, and here's my little quick roadmap. Let's say you have $100, $500, or $1,000 in, your bank account. You want to put it into a brokerage. Find yourself a decent brokerage. Make sure that it's actually giving you the asset classes you need. So if you're going to be trading NASDAQ on the futures, make sure it's futures. If you're going to be trading CFDs, make sure it's CFDs. And whenever you're going to be trading, just make sure that whenever you actually are placing your trades, whenever you are, scaling up your account, that you are not incurring massive fees, massive commissions, etc. Because whenever you have a smaller account, you can get screwed badly, right? Whenever I started off with trading options, I would lose 5% of my whole account just to commissions because it costs a lot to be trading options on most of these brokers. And there's obviously going to be all the slippage issues because, options move very fast, especially 0DTEs. So you're actually going to end up losing quite a lot just due to fees. And whenever you add in, spreads and such things, if you don't know what you're doing and you're using a shitty broker, you could actually be booked. In other words, you could be trading against the broker. So just be careful of that, because if you have a $100 account, you could easily lose like a quarter of your whole account just due to, spreads, commissions, and stuff like that on one trade. So be aware of that, because that is one thing that's really important to be aware of. Then the other thing that comes to my mind is, if that's not an issue and you're doing okay in that end, just make sure that your data actually allows you to scale up your account. Make sure that your backtest actually aligns. Make sure that you're not going to get 10 losers in a row based off your data. And, let's say risk 50% of your account per trade. It makes no sense. If you want to scale up your account and you know that you're going to get 2 losers in a row, multiple times per week, you're going to blow your account. You're guaranteeing it. Meanwhile, if you know you can lose, let's say 5 trades in a row, which is quite normal, then you could be risking 15, more realistically 10% of your account, and you'll actually be chilling. You'll be able to actually grow your account in the long term. If you know that you can do 10 R per month and you're risking 10% of your account, then you can actually double your account month over month. That doesn't mean you're going to go from 100 to 200 and then 200 to 300. You go from 100 to 200, 200 to 400, 400 to 800. Right? So obviously it'll take a couple months, but you are scaling a small account and you are getting very, very good returns. And once again, if your data aligns with your real account, then you're going to be able to do incredible things, because 100 to 200, 200 to 400, 400 to 800, 800 to 1600, 1600 to 3200, that's a 32x, 3200 to 6400, 6400 to 12,800. Obviously, each and every one of these, jumps takes like roughly a month. If you make 10 hours per month, then you have the data that I just talked about. It does take a while, but if you can optimize your data and you can potentially risk more, once again, like I said, if you just spend 1 month trading and your data looks like that, but then you find ways to optimize it, right? You find ways to get less losers in a row, find ways to risk more, find ways to get more R per month, then, you can also apply dynamic risk management. You could reduce your risk as you're actually in a losing streak, or you could increase your risk as you're winning. If you were to get 5 winners in a row and you were to increase your risk a couple of times, then you are going to be potentially putting yourself in a position where you could triple your account in just 1 month. So just be aware of that. But like I said, it's not optimal to try to flip a small account. You're going to get screwed in so many different ways, and all it takes is one bad move and the entire account will be gone. Whether you started with 100 and you have 100,000, or it's just 1,000, it doesn't even matter. All of it could be gone just like that, very easily. Meanwhile, with a prop firm account, it's going to be a lot less likely. Obviously, you can get banned from a prop firm. You could get, your account denied. You could get, your payouts just taken away from you. That's not really my point. My point is that once you get funded, as soon as you get a payout, you are completely risk-free. Whether it's a 5K funded or a 400K funded, it's the exact same thing. Some of them will refund you the fee, but even if they don't, it's usually 0.5% profit, maybe 1%, and you've just made a full ROI. So that's the case with funded, which I really like. On top of that, you can buy multiple funded accounts from different prop firms, which means if you get banned from one, or if you lose an account, or if you break a rule, or if you get a payout denied, you still have another payout coming in from somewhere else. You still have another account getting passed from some other prop firm. So that's all that really matters, is that you have diversification. Obviously, you could diversify in terms of, your different accounts on different brokers with your own capital, but I still don't recommend just doing that. I'd recommend doing both, right? But focusing more on prop firms, especially if you're trying to scale up, because with $100, you can get a 10K funded account. If you have the right data, you can very easily practice 3, 4, 5 times to simulate that account with just demo trading. If you can pass it easily, then all you need to do is just buy the account, pass, get a small payout, and you've gone back your $100 and then some. Then you can buy 25K account with the payouts, and then a 50K. Worst case, you lose those accounts and you still have your 10K funded account. With that being said though, just remember, you need to have realistic growth expectations. Just because you see somebody on YouTube that goes from $100 to $1 million in a month or in 3 months, doesn't mean it's actually doable, all right? Most of them will fake a lot of shit. Even if it looks real, trust me, there's a lot of ways to figure out that it's fake. And if you can look up a person's name and scam or fake or something like that, or exposed, it probably means that guy has faked a lot of things in the past, which means the thing you're looking at right now might be faked, all right? There is no easy way to know whether you're going to be able to flip an account from $100 to $1,000 or from 1K to $1 million, apart from having your own data. And even if you have your data from your back test or whatever, you can't fully trust it because the live markets could be totally different. So just remember that, guys. It's not always as simple as, oh, well, Seb, I can make this much and this is my data, so this is what I'm going to do in the live markets. If you've never traded live, you will have, most likely a lot of issues getting those results, because it's not just going to be statistical losses, which is losses based off you following your trading plan perfectly. It could also be a loss, like I said earlier, in terms of revenge trading, in terms of maybe not following your plan, getting greedy, getting fearful, not taking a trade when you're supposed to, waking up late, so many different things. So just remember that, all right? For your first, 100 trades realistically live, you're most likely going to have certain execution mistakes. If you're doing things properly and journaling and improving, after 20, 50, 100 trades, you're probably going to be able to execute the same way that you would on FX Replay. And once you build consistency, everything changes. But the problem is most traders, they scale too fast and they just lose it all. So if you're thinking, well, look, I've gone from $100 into $500, right? Flipping my account. And I want to scale it up to 5K as soon as possible. You're thinking of changing your risk or something, but you've never actually done anything like this before. You've never traded with more than, $50 or $100 risk. You are potentially going to encounter some issues, like I said. So I don't recommend trying to scale too fast. I would recommend going step by step and being extremely aware of what your emotions are telling you, what your mind is telling you, and what your journal is telling you. In other words, what you wrote in the past. Because whenever you're reviewing your journal every day and every week and every month, you will very easily be able to tell when you are encountering issues. You'll notice, oh, I felt a lot of emotion with that trade. What's the difference? Oh, last trade I risked $50. This trade I risked $200. In other words, last trade I risked 20% of my account. This trade I risked 60%, for example. That makes a very big difference, right? In terms of how much you're risking, how close you are, at least how close it feels you are to losing something. In other words, losing your account, having to start over. That's when emotions will kick in. So you don't want to scale too fast. And whenever it comes down to prop firms, honestly, I would not recommend trying to go too big. Like if you have a 10K account, which you managed to pass and that was all the money that you had, don't try to go for a massive payout. Just go for like 1 or 2%, get an ROI, get a little bit extra to buy another account. Once you have the other account, don't buy the biggest account that you can with that. Keep a little bit extra just in case, all right? Give yourself at least like 2 tries. So if you were to get, let's say, a 25K funded account and you were to make a $2,000 payout, don't go straight for the biggest account you can buy. Budget for 2 of them, right? Budget for 2 200K accounts. That way, if you lose one, you still have extra to actually get another one, no matter what happens with the previous ones that you have. Make your life easier. And you have to remember, guys, at a certain point, you're not just trading anymore. You are running a trading business. You need to take this seriously, all right? Like I said, you cannot just randomly place trades and hope you'll make money. Trading is something serious. It's the same thing as if you were to become a doctor, right? Think about it like that. You think, whenever you think of becoming a doctor, you think, okay, I need to save up a lot of money for tuition, and I need to get ready to get into some sort of debt. I need to get ready to put in hundreds or thousands of hours over multiple years to just be able to know that I'm actually eligible to even become a doctor, in other words, going to university. And after all of that, then you can actually start to make money and operate as a doctor. And even then, there's still a pretty big learning curve for you to apply it in a real situation. So why is trading any different? Why don't we treat it like an actual proper business? Why don't we treat it like a professional skill? Well, the reason why is because most people on TikTok, they don't treat it that way. And let's just say, surprise, surprise, they don't do very well. Well, they do well selling their course, I'll tell you that much, but they don't do very well with their trading, if they even trade. One thing that I've seen a lot, in my career is people will say, so I don't want to miss a trading week, right? Because, on average, I make like 3R or 5R per week. Dude, I have this much funding now. Like, if I were to just stop, and I would just want to make anything. There's no paid leave. There's no prop firm that's going to pay me out even if I'm not trading. Obviously, that's true. But remember, why are you trading? Like, what is the point of you trading? Why did you do this and not just get a 9 to 5, right? most of you are going to be able to say freedom. Is it freedom to not be able to step away from your computer for one trading day or just one trading week or even one trading month? Dude, if last month you made like $20,000, right? And that's a lot of money to you, and that covers multiple months of expenses and whatever, you're good. Like, you don't need to just keep trading every single day and think, oh, I'll do another 20,000 this month, or I'll do 30, or I want to get as much as possible. You need to be focused in on what is trading doing for me? What is it doing for my life? If it's stressing me out, then maybe reconsider. The last thing I'll say on this point, guys, is you need to have some sort of mindset shift if you want to go from trading a $100 personal account to trading a $100,000 personal account, or managing $1 million worth of profit from capital. You need to have this shift of, I don't need to always be trading, all right? I always need to be placing trades just because my edge told me to. You know, I've seen a lot of traders go on vacation and they're still trying to place trades on vacation. I don't see any point in doing that unless you really want to and, you know, you're good, right? But if you're in a position where you feel like you're forced, or you just don't really want to, but you feel like you have to, I would say just take the time off. Whether you're actually going to get a big week or you're going to get, you know, a red week, it doesn't actually matter. What matters is that you give yourself that time and that space. So the mindset shift really is just focusing on you and your health and your family and whatever matters the most to you in your life, not in the charts. Charts are great. Charts are fun. But honestly, the times where I have taken time away, a week, 2 weeks, or even 3 weeks away from the charts and trading, usually I come back way stronger and I make up for those couple of weeks within just a couple of days. So that might always be the case, but whenever it is, it sure damn fucking feels good knowing that I actually gave myself the time and space I needed and I made quite a lot of money. Even after scaling successfully, you'll probably never really reach a point where mistakes stop happening. At least I haven't. After 5 years, here's how I managed the inevitable slip-ups and setbacks that come with real-world trading. Now, a common error that a lot of experienced traders will make is waking up a little bit too late. All right, maybe I went to bed a little bit too late the night before. Maybe there's something, you know, important that happened and I just couldn't really avoid it, and I just woke up a bit later. Or maybe I forgot to set my alarm, or maybe, you know, I just didn't have an alarm, or I didn't hear it. It's going to happen occasionally where I'm just not going to take a trade, and maybe it was a great day. You know, in the case where I would have made 2 hour or 3 hour in a day that I didn't trade, I might consider that a loss, and I will journal that and I'll make sure that I'm aware of that so that I can avoid it. It does happen, right? And there's not really much that you can do about it apart from just trying to be prepared, but life happens. So that's one of the most common things that I've seen. Another common thing that I've seen before is sometimes you're just tired or you're not really fully present. Maybe something else is happening around you. Maybe, you know, whatever, you're in a busy place, or maybe you have a lot on your mind. Maybe you click buy instead of clicking sell. Maybe you set your take profit or stop loss wrong and you instantly get out of the trade. Maybe you risk a little bit too much or too little. These are the little things that can happen. These are execution mistakes, all right? But typically, once you're experienced, you're not going to be dealing with very many like petty mistakes. You know, that's what I would call, for example, you know, like revenge trading. I would call that a petty mistake. Because if you have multiple years of experience and you're still making that mistake consistently, then clearly you don't actually have years of experience. You have years of bullshitting yourself. So trust me, guys, if you've still been revenge trading after a year, you're probably not journaling or trading properly. All right, hit me up in my DMs if you need help with that. I mean, honestly, I want to help you guys with this shit because it's not fun to be revenge trading. All right, I've done it before. I've wasted hours and actually weeks where I didn't trade and felt like total garbage because I blew up many accounts. So once again, if you're professional and you're still making mistakes, it's totally normal. I've lost, you know, a lot of money over even just this year from missing trades or from misplacing trades or from just not setting the right take profit, right? Maybe I set it too early or too late. Maybe I just closed the trade randomly, right? That happens sometimes. You enter and you accidentally close the trade. Shit happens, guys. It's not the end of the world. The difference between year 1 and year 5 isn't perfection. It's having systems that prevent disasters. If we're going to talk about systems, we should be talking about the one that I mentioned earlier, which is automatic risk management and be able to trade straight off TradingView. So you don't want to be in a position where you are entering without a stop loss with 10 lots and nothing stops you from doing that, or nothing stops you from getting all of your trades closed out of your account at the click of a button or automatically once a certain profit or loss is met. If you don't have that kind of thing set, then you are most likely setting yourself up for failure. If you don't have any sort of maximum daily loss set on your account where it's going to close all of your trades as soon as it hits a certain level or a certain time, you're going to lose your account from a rule break. If you are trading on a personal account, I don't give a shit. It's the same thing. If you go in with 10 lots instead of 1 lot by accident, no stop loss, and your shit freezes, there's a big ass news that just hits the charts, you're probably going to lose your whole account. You're probably going to get your shit liquidated or get your account 10x'd, most likely liquidated though. So
Honestly, whether you're trading personal funds and there's no quote unquote rules, or whether you're actually trading with a prop firm, you should always have some sort of system which automatically closes all of your trades as soon as you hit a certain profit or loss for the day, just in case. And of course, if you have a system which allows you to avoid a trade even being executed onto your real account without a stop loss, great. Right? Because I've definitely been tempted to just randomly enter a trade. I clicked buy. An hour later, I realized, oh, wait a minute, I didn't get into that trade because I didn't have a stop loss set. So my position size calculator, which automatically places my trades for me and my risk, couldn't do anything. Because if there's no stop loss, how do you even set your risk? How do you know how much to risk, right? It's not possible. If I had to start over with everything that I know now, here's exactly what I would do. Here's your 30-day action plan. All right, week by week, in case you really need the help, or even day to day. What you need to focus on to actually become profitable, whether you've been trading for a while or you're totally new to this, is starting off with learning the bare bones basics. Figure out what the fuck TradingView is. Everything I said, it needs to make sense to you. Watch a few YouTube videos to understand basic trading terminology. Go back and forth with ChatGPT. Have a trading conversation and ask it a question whenever you don't understand something. Maybe watch a YouTube video and then ask ChatGPT questions about it. There's so many ways for you to actually go about this to improve. You don't need to do anything more than spend your first couple of days, maybe even just your first day, understanding the basics and mastering those. Once you understand trading terminology and you understand what the charts look like, then it's time for you to actually figure out what the fuck kind of strategy will I use. This is all going to be in your first week. Figure out what strategy you want to use. Start to look at the charts. Just get TradingView. It's totally free. And figure out, okay, what are the main concepts? When does this occur? And start to draw it out on your charts. Start to just look through and find these things happening. A fair value gap, liquidity zone, an order block, PD array, whatever the fuck you guys want to use. Figure it out and get used to it. Get comfortable in TradingView. Once you've done that, your second week should be focused in very, very heavily, straight up, just on back testing. And as you're back testing as well, throughout the day, whenever you actually do have your trading session that's happening, demo trade. Make sure that your back testing is actually aligning, and make sure that you're actually able to apply it properly in the live markets. Make sure you're able to execute at the right times and your results are similar. And at the same time, you'll be able to practice journaling. It's going to be a very important week. Ideally the one that you're most locked in on, because you're really going to need to make sure that this is done properly, or the rest will not matter. Week 3, this is where you're actually going to go into the real markets, where you're going to be demo trading, kind of like how you were the last week, but now you have your data and you're good, and you're going to simulate yourself a prop firm challenge or some sort of challenge for you to grow an account. Just open up the demo account and just place your trades, journal them, and you're good to go. The 4th week is when you're going to actually apply it into the live markets with an actual real account to see if you can actually get the same results, whether you're going to pass a prop firm challenge, get some payouts, or scale up your personal account. That's the best 30-day plan I can give you. Obviously, you could take all of these points and you could stretch it out over 90 days, over a year. But the main thing is you just need to make sure you're actually gathering data and you're applying things as you learn them. If this just saved you years of expensive mistakes, hit the subscribe button for more real trading content every single week, and watch my trading strategy breakdown next. It's the perfect follow-up to implement what you just learned.